This video of a wave crashing in reverse illustrates the inverted timeline of an insurance contract. An insurer collects cash today, but assumes an obligation whose true cost might not emerge for decades. For years, legacy accounting standards allowed insurers to treat these upfront premium receipts as immediate, ordinary revenue. Treating cash received as immediate income distorts the balance sheet. It divorces the reported revenue from the actual economic exposure and risk the insurer is holding. IFRS 17 forces a departure from this cash receipt model. It requires insurers to report based on current fulfillment and actual service delivery. To achieve this, the standard relies on a strict three-part pipeline: aggregation, recognition, and the measurement engine. This structure prevents companies from hiding risk. It ensures the financial statements reflect a probability-weighted estimate of the insurer's actual promises. Historically, insurers could rely on broad offsetting. They could bury expected losses from underpriced contracts inside large pools of highly profitable business. This animation shows how IFRS 17 blocks that offsetting, starting with the level of aggregation. The first filter forces a massive, unstructured cloud of individual contracts to funnel down into distinct silos, known as portfolios. To belong in the same portfolio, contracts must possess similar risks and be managed together operationally. Inside each portfolio silo, the contracts separate further based on their expected profitability. The standard demands at least three distinct groups: onerous contracts that are loss-making at inception, resilient contracts that have no material possibility of becoming onerous, and the remaining profitable contracts. Isolating the onerous group is the crucial step. It strips away the cover of profitable policies, forcing expected losses into the light immediately. Finally, we apply the annual cohort rule. A rigid plane slices through the groups, sealing them shut by year. Contracts issued more than 1 year apart cannot sit in the same group. Without this 12-month boundary, an insurer could use a new, profitable generation of business to absorb the deterioration of older, poorly priced policies. Once a contract enters its group, it cannot leave. If a profitable contract turns sour years later, management cannot reassign it to a stronger pool to protect their reported margins. This rigid unit of account acts as a structural barrier. It ties the profit and loss statement directly to the specific underwriting decisions made in a given year. Once these closed groups are established, the accounting system must determine exactly when they are legally recognized on the balance sheet. This timeline shows the earliest of 3 dates rule. 3 triggers hover: coverage start, payment due, and onerous date. The first trigger, coverage start, locks onto the axis. It marks when the insurer stands ready to pay claims. The second trigger is the date the first premium becomes due, representing when the insurer gains enforceable financial rights. The third trigger applies only to onerous groups. The onerous date snaps to the far left, bypassing the others entirely. If pricing data shows a group will be loss-making, recognition occurs immediately upon that realization. The insurer must record it even if coverage has not started and no premiums are due. The model applies deliberate asymmetry. Expected profits must wait for actual service delivery, but expected losses demand immediate financial accountability. After a contract hits the balance sheet, the standard defines how its uncertain future is mathematically valued. This graphic builds the measurement engine from the ground up. The base layer represents expected future cash flows, containing a probability distribution curve of potential outcomes. Management cannot rely on a single best estimate. They must generate explicit, probability-weighted estimates that cover the entire range of possible scenarios. This includes low-probability, high-severity tail risks, like mass litigation. The second building block is the time value of money. A yield curve compresses the total height of the cash flows to reflect their present value. These discount rates must align strictly with observable market characteristics, linking the liability to macroeconomic realities. The third element is the risk adjustment. It locks on top, extending the block slightly to create a buffer. This represents the explicit compensation the insurer requires for bearing non-financial uncertainties, like sudden shifts in mortality or unpredictable policyholder lapse behavior. Together, these 3 blocks form the fulfillment cash flows. They provide an unbiased, current estimate of the absolute economic burden the insurer has promised to carry. If a group is profitable, the premium receipts will exceed these calculated fulfillment cash flows. The standard must address where that excess value goes. This final top block is the contractual service margin, or CSM. It drops into place, perfectly leveling the stack to offset the day one gain. The CSM is a liability representing unearned profit. It explicitly prevents an insurer from recognizing a financial gain on the first day a profitable contract is signed. Instead, the CSM is systematically amortized into the profit and loss statement as the insurer actually delivers coverage units over the life of the policy. An onerous group behaves entirely differently. When the CSM block drops down, it shatters on impact, and a red loss component drops directly into the P&L document. Because there's no unearned profit to defer in an underpriced contract, the CSM is zero. The net outflow hits the profit and loss statement immediately. The CSM redefines insurance revenue. It's not just cash collected, it measures services successfully delivered. This diagram shows how the abstract measurement blocks map cleanly onto the final financial statements. The CSM flows into liabilities, the release of coverage units drives insurance revenue, and the discount rates flow into insurance finance income and expenses. This architecture isolates key variables for analysts. They can separate an insurer's underwriting service performance from the volatility of financial markets. Operationally, this requires a unified data structure. Actuarial risk models, legal contract parameters, and financial ledgers must exchange information seamlessly. A single error in a contract issue date or identifier flows directly into the final calculations, potentially misstating revenue or masking an onerous loss. IFRS 17 operates as a strict structural framework. It forces the insurer to continuously prove its true economic reality to the world, one probability-weighted block at a time.